Welcome to my channel. Let's look at this topic right now. The horror of human and economic losses from the coronavirus continues to stimulate the need for strategic diversification and the demand for non-hazardous storage. Meanwhile, pro-cyclical commodities such as oil and copper saw that their recent recovery was shocked by new concerns about the spread of coronavirus infection outside of China. For example, the price of crude oil fell to $10 per barrel. The main source of influence on commodity markets is still a large amount of information about the Covid-19 virus and, therefore, the likely danger of its subsequent spread in Asia and beyond. China, already shocked by economic and human pressure, is trying to return to a restoration of its position before the coronavirus pandemic. January was a very troubling month for markets, followed by an outbreak of coronavirus. During January, aggregate stocks in ETFs secured by ingots grew by an average of 1.3 tons per day. In February of this year, stocks, despite the aforementioned dollar appreciation and stock market recovery, rose 1.9 tons per day. While Goldman Sachs expects gold to rise in price to $1,750 an ounce, Citibank said it could reach $2,000 an ounce over the next 12 to 24 months. An outbreak of coronavirus is likely to lead to its growth, since it is difficult to determine what can stop the engine at this stage, perhaps in addition to its own success, which has led to a short-term overbought market. As stated earlier, goods are much better understood than stocks when it comes to the important consequences of the COVID-19 outbreak. Last but not least, given that the epicenter is located in China, the world's most dominant consumer of raw materials. Based on this, we remain concerned that the full impact on other markets as a result of the slowdown in China and abroad is not being properly assessed. The stock exchange has rebounded strongly as investors become more resilient to obvious risks. Instead, they specialize in support from low inflation, low interest rates and central banks led by the U.S. Federal Reserve, which continue to pump liquidity into the market. Here, in this review article, I express my personal observations and opinions. Register using the links and get dividends. More information about addresses on the screen.